Markets closed. The dust is settling, and we're still standing. This is Theta Fuse.
We are still here.
Welcome back to the Deep Dive. It is Monday evening, February 9th, 2026. If you are listening to this, congratulations, you survived the session. And honestly, today was one for the history books.
It certainly was. I mean, it is not every day you get to witness a milestone like the one we saw at the close today. It feels significant, doesn't it?
Significant is, that's an understatement. Let's not bury the lead here. The Dow Jones Industrial Average has officially crossed and closed above 50,000.
50,000.
It closed at 50,115.67 to be exact.
Yeah.
50,000. I mean, that is a massive psychological number.
Huge.
I remember when we were popping champagne for 20,000.
It feels like a lifetime ago. But, despite that massive headline number, and 50K is a huge, huge psychological barrier for, the retail public, the feeling on the street isn't exactly unbridled joy. It feels heavy.
That's the vibe check. You nailed it. It feels euphoric because of the number, but it also just feels exhausting. The S&P 500 is creeping back toward records. It was up about, 0.5% today?
Right.
The NASDAQ had a nice bounce of 0.9%. But man, it feels like we are dragging a lot of baggage up this hill. It doesn't feel like a party.
No.
It feels like a relief rally.
I think relief is the right word, but I'd probably add anxiety to the mix. We're coming off a really volatile week.
Oh, yeah.
I mean, last week was a roller coaster. We had that liquidity scare, the crypto flush. So I think traders are just happy to see some green on the screen without the floor falling out.
For sure.
But the exhaustion is real because the breadth isn't exactly screaming bull market.
Not at all.
We're seeing rotation, we're seeing geopolitical headlines, and we're seeing these massive moves in specific names that are they're eye-watering.
Speaking of eye-watering, we have to talk about the insane move of the day.
Oh, yeah.
I'm looking at the energy sector, which has been, asleep at the wheel for a while, and then suddenly, bam.
Woke right up.
Ticker symbol VAL, Valaris.
Valaris, yeah. The offshore driller.
This thing didn't just move, it teleported. Up over 34% in a single session.
34%?
If you are holding calls on this, dinner's on you tonight.
Oh, definitely.
So let's unpack this. The catalyst here is Transocean ticker RIG is buying them.
Right.
It's an all-stock deal valued at about, $5.8 billion. Now, I want to get your take on this because usually M&A is a pretty simple playbook. The company getting bought pops, and the company doing the buying, it drops because they're either spending cash or diluting their shares.
Right. That's the standard.
But Transocean actually reversed early losses and finished up around 6%.
That's rare, isn't it?
It is rare, and it's a very, very specific signal. When the acquirer's stock goes up alongside the target, it tells you the market thinks the deal is accretive, immediately.
But more importantly, it signals a shift in the sector cycle. For the last, decade, energy, specifically offshore drilling, has been in what we call a capital discipline phase.
Right.
Investors punished companies for spending money. They wanted dividends, they wanted buybacks, and they wanted executives to just sit on their hands.
Right, the whole don't drill, just pay me era. We've talked about that.
Exactly. But this deal, this is Transocean saying, the era of austerity is over. We are going into empire building mode. And the fact that the market rewarded them for it suggests that investors agree.
They like it.
They see the supply constraints coming. The energy sector has been fragmented. So putting two giants together, it creates efficiencies, sure, but mostly gives them pricing power. It's the market saying, finally, someone is cleaning up this space so we can charge more for the rigs.
So it feels like the energy sector is finally waking up.
It does.
We've been so focused on tech, and suddenly the old school drills are making 30% moves. It's wild. But okay, let's pivot. Because while we're all staring at these flashing numbers, Valaris up 34%, Dow 50K, we need to ask, why? Why are we doing this? Why are we staring at screens at 8:00 p.m. on a Monday?
It's the existential question of the trader, isn't it?
It is. And I want to get into our first deep dive segment, which is all about the owner mentality. Because Larry Fink, the CEO of BlackRock, basically the guy who owns the world.
Pretty much.
He made some comments recently at Davos regarding AI that I think are absolutely critical for everyone listening to understand this isn't just market noise, this is, philosophy.
These comments were fascinating, and honestly, if you read between the lines, they were a little bit chilling.
So let's unpack this. Fink is basically warning that AI is going to fail if people just sit back and watch it happen. He's drawing a comparison to the post-Cold War era.
Right. To understand his point, you have to look back at the 1990s. The Berlin Wall falls, Soviet Union dissolves, and suddenly you have this massive opening of global markets.
Right. Globalization.
Globalization kicks into high gear. We saw immense wealth creation. Trillions of dollars in value were generated as supply chains optimized and new markets opened up. But Fink's point, and he's right about this, is that the wealth was created, but it was incredibly uneven.
It didn't reach everyone.
Not even close. It accrued to a very narrow slice of the population. You know, the people who own the factories, the intellectual property, the supply chain logistics. Wages in the developed world, they just stagnated for the working class while asset prices soared.
And he's worried we're about to run that exact same play again, but on steroids with AI.
Exactly. His specific warning, and this is the quote that really stuck with me, was, "Early gains are flowing to the owners of models, owners of data, and owners of infrastructure."
Owners of infrastructure. That's the key phrase right there.
Yeah. It is. He's saying that if you are just a spectator, if you're just a worker using the AI to write your emails faster, or you're a consumer buying the AI product, you're going to get left behind. The productivity gains from AI aren't going to result in you working fewer hours for the same pay. They're going to result in higher margins for the company that owns the AI.
Aye.
The value isn't going to the user.
It's going to the owner.
It's going to the owner.
This is literally the philosophy of Theta Fuse. This is why we do this. This is why we trade. You have to be in the game. You cannot just sit on the sidelines and say, wow, ChatGPT is cool. You have to own the company that makes the chip that ChatGPT runs on.
And Fink takes it a step further. He says this isn't just about making money, it's about social stability. He warned that without broader ownership, AI deepens the trust deficit.
The trust deficit.
Yeah. We already live in a world where people don't trust institutions, banks, governments, the media.
For sure.
So if AI creates another massive wealth gap where the top 1% own all the robots in the data centers and everyone else is just watching, that's a recipe for a social disaster. It evokes a sense of hopelessness.
So what's the solution? Because usually these guys, they just point out the problem and then fly away in their private jets.
Well, his solution is interesting, mostly because it serves his business model, but it's still valid. He's talking about how capitalism has to evolve.
Right.
He says, and I'm paraphrasing here, capitalism can evolve to turn more people into owners of growth instead of spectators. He's specifically talking about pension funds and retirement savings.
Right. Getting the average pensioner access to these infrastructure plays.
Right.
Because right now, a lot of the best stuff is private or it's locked up in these massive conglomerates. But for our listeners, for the retail trader, the message is crystal clear. Stop watching.
Start owning.
Start owning.
Precisely. If we are entering an age where capital, and by that I mean the AI models and the servers, is going to replace labor, you do not want to be the labor.
No.
You want to be the capital. You need to own the infrastructure.
Which brings us perfectly to our sector breakdown. We're calling this segment Chips, Pills, and Drills.
I like it.
Because that is literally where the money was today. Let's start with the chips, the infrastructure Fink was just talking about.
This is the plumbing of the AI revolution.
It is. Today, we saw the usual suspects doing their thing. NVIDIA was up 2.4%. Broadcom up 3.3%.
The toll roads.
They are the toll roads. If you want to build a model, you pay a toll to Jensen Huang at NVIDIA. You pay a toll to Broadcom for the networking. That is owning the infrastructure 101.
And notice the resilience there. Even with the market feeling exhausted, the toll road stocks keep grinding higher.
They do.
That tells you the big money, the pensions Fink is talking about, they're parking cash right there.
But the real story today wasn't the big guys. It was the sleeper hit. SanDisk, ticker SNDK.
Yeah, this was a massive move.
I'm seeing some sources say 12.8%, some say over 15%. It was volatile. But a double-digit move for a storage company? What is going on there?
It comes down to the difference between compute and memory. We focus so much on the GPU, the compute part, but AI models are getting bigger. Trillions of parameters.
Right.
You can't just process that. You have to store it, and you have to retrieve it instantly.
So this is about NAND pricing. Is that what's happening?
Exactly. There are two types of memory really driving this. There's HBM high bandwidth memory, which is what NVIDIA puts right on the chip. That's the short-term memory.
Okay.
But then there's NAND flash. That's the long-term storage. For a long time, NAND prices were in the toilet. Too much supply, not enough demand. It was a commodity.
I remember that.
But now, with AI data centers exploding and inference models needing to pull data from local storage constantly, demand is just skyrocketing.
And supply is tight. Is that the other half?
Supply is incredibly tight because
Yeah.
manufacturers cut production last year when prices crash. So now you have a supply squeeze meeting a demand shock. SanDisk is just pure leverage to that pricing power.
So if NVIDIA's the brain, SanDisk is the filing cabinet.
A very, very fast, very expensive filing cabinet.
Okay.
And the market is realizing we're running out of filing cabinets.
I love it. So that's SanDisk. But then we have the drama king of the semiconductor world,
Oh, yes.
Intel, INTC.
Oh, Intel, the stock everyone loves to hate.
Listen, they gained over 10% today. 10%. For a company that people have been leaving for dead for 2 years, what sparked this?
It's a mix of things, but I think the narrative that's shifting is the handheld gaming news. There's talk about a new platform using their Panther Lake chips.
Panther Lake sounds like a camp I went to in the 90s.
It does, but look, here's the context. Intel has been struggling, really struggling, to prove it can make efficient chips.
Right. Hot and power hungry.
Exactly. Handheld gaming devices like the Steam Deck or the Switch, they require incredibly efficient chips. You can't have a fan sounding like a jet engine in your hands.
No. So if Intel is getting designed into a handheld, it means Panther Lake might actually be good.
It implies that their efficiency problems might be solved, and the market is starving for a turnaround story. We all know Intel has missed the boat on a lot of things, but if they can show hardware innovation, if they can show they can put a powerful AI-capable chip into a handheld device that people actually want to buy, that changes the multiple on the stock.
So expert opinion time. Is this a value trap? Or is this the real deal?
Yeah.
Because I've been burned by the Intel turnaround narrative before.
I would be very cautious about calling it the real deal just yet.
Okay.
A 10% move is great, but it's likely a lot of short covering. The market is rewarding hardware innovation right now, so they get the pop. But Intel has a history of promising big and delivering medium.
Delivering medium,
Yeah.
that's generous.
I'm trying to be diplomatic, but look, a 10% move on volume shows that big money is at least willing to take a look again. It's a show-me stock.
Right.
They showed us a glimmer today. Now they have to actually execute.
Okay, so that's the chips. Let's move to the pills. The healthcare drama today was spicy.
It really was.
We've got a lawsuit showdown. Novo Nordisk versus Hims and Hers.
This is a fascinating battle because it's really a battle over access versus intellectual property. It's a classic fight.
So set the stage for us. Novo Nordisk makes the heavy hitters Ozempic, Wegovy, the semaglutide drugs.
Correct. And they are patented. They own the IP. But there's a shortage. And when there is a shortage of a drug, the FDA allows pharmacies to make compounded versions.
Right.
Basically mixing the active ingredients themselves to meet demand.
And that's where Hims and Hers comes in. They've been selling these compounded versions for way, way cheaper than the brand name.
Exactly. And they've been making a fortune doing it. I mean, it's been a massive growth driver for their stock.
And now Novo is suing.
Now Novo is suing, claiming that these compounded versions are not safe or they're knocking off the brand too closely. They're trying to shut down that whole compounded pipeline.
But market reaction was immediate. Novo stock rose 3.6%. But Hims... Man, Hims did not take this lying down. Did you see the response on X?
I did. It was aggressive.
They blasted back. They said Big Pharma is weaponizing the U.S. judicial system to limit consumer choice. I mean, that is fighting words.
It is. And honestly, Hims is playing a populist card here. They know the public hates Big Pharma pricing.
Of course.
But in a court of law, people like cheap drugs isn't a legal defense against patent infringement or safety regulations.
And for a trader, this introduces what we call headline risk. Can you break that down?
This is so crucial to understand. Headline risk means the stock price isn't moving based on how many pills they sold yesterday. It's moving based on what a judge says in a courtroom.
Okay.
If a judge issues an injunction stopping Hims from selling semaglutide, the stock crashes 30% overnight. If the judge throws out the lawsuit, the stock rips 30%.
So the technicals go out the window.
Completely. You can draw all the trend lines you want, but the judge does not care about your Fibonacci retracement. You are no longer betting on the business, you're betting on the legal outcome.
It's a coin flip.
It's a massive volatility event. Unless you have a law degree and inside info, it's a coin flip.
So if you're holding Hims and Hers, you are basically holding a lottery ticket on a court case right now.
Pretty much. And Novo is the 800-pound gorilla. They have deep, deep pockets for legal fees. It's a David versus Goliath situation. But Goliath is really annoyed and has very good lawyers.
Okay, let's wrap up the sector scan with the drills. We mentioned Valaris and Transocean at the top, but zooming out, why now? Oil prices actually fell slightly today, right?
They did. There were some worries about U.S. military action against Iran, which usually spikes oil, but the market kind of shrugged it off.
Interesting.
It seems the market believes either the conflict will be contained or that demand is softening enough to offset any of those supply risks.
So if oil is down, why are the drillers up? It feels counterintuitive.
Because the business of drilling is different from the price of oil. Even if oil is $70 or $80, these companies need to replace their reserves. They have to drill. And offshore drilling is expensive and complex.
Right.
By consolidating Transocean buying Valaris, they can control pricing better. They can stop undercutting each other on rig rates. It's about pricing power for the service, not just the commodity price.
Got it. So they are cleaning up the neighborhood so they can charge higher rent.
That is a perfect analogy. And remember, these fleets are aging. No one has built a new offshore rig in years because of ESG pressure and lack of capital, so the existing steel is becoming more valuable.
So Transocean is buying old steel.
They're buying existing steel because building new steel is too expensive and takes way too long.
All right, let's zoom way out. We've looked at the sectors, but we have to look at the macro noise. Because there is some stuff happening at the borders that is making me nervous.
Geopolitics is definitely weighing on the market, even if the Dow at 50K obscures it. We have some real friction developing in North American trade.
The big one is the Windsor-Detroit Bridge. President Trump is threatening to block the opening of the new bridge.
This is critical. I don't think people realize how much money crosses that river every single day.
Give me a number.
The Ambassador Bridge Corridor handles over 25% of all merchandise trade between the U.S. and Canada. We are talking about $300 to $400 million a day in goods.
A day.
A day. And it's not just finished goods, it's the auto industry supply chain. Parts go back and forth across that river 5-6 times before a car is finished.
Wow.
A steering wheel made in Michigan goes to Ontario for assembly, then it comes back to Detroit.
So if he blocks the bridge, or even just slows it down...
You break the just-in-time manufacturing model.
Yeah.
You get supply chain headaches, you get delays, you get higher costs. Factories have to shut down because they're missing one part. It's an economic artery.
Right.
And if you clamp an artery, the patient, in this case, the economy, starts to feel it immediately.
It's leverage. He's using it as leverage.
It is leverage, but it's a dangerous game. It's inflationary. If you slow down trade, prices go up, period.
And we're seeing travel chaos, too. Canadians stuck in Cuba, airlines adjusting flights. It just feels like the transport and travel sectors are facing these weird geopolitical headwinds that aren't about demand. They're about governments fighting.
It creates friction. And markets hate friction. They want smooth sailing. When you have friction, you have lower margins. It's that simple.
Speaking of friction, let's take the crypto corner. Bitcoin had a scary moment last week. I mean, we dropped near $60, Kay. Where are we now?
We're stabilizing. Bitcoin is hovering just below $71,000.
Is the panic over?
I think the acute phase of the panic is over. We called it a crisis of confidence last week. That seems to be passing. But we have to remember we are still a long, long way from the October highs of $126,000.
That feels like a lifetime ago, 126K Bitcoin.
It does. But seeing it hold 70 tega is important psychologically. And look at gold and silver. Gold up 2%, silver up almost 7%.
That's a big move for silver.
It is. And when you see precious metals stabilizing alongside crypto, it tells you that the debasement trade is back on. People aren't selling everything anymore like they were last week during the liquidity crunch.
Okay.
They're starting to pick their spots. They are buying the hard assets again, crypto, gold, silver. It's a hedge against all that geopolitical friction we just talked about.
Okay, so the panic selling is done. Now the strategic buying begins. Which brings us to tomorrow. Tuesday, February 10th. I'm going to tell everyone right now, clear your charts.
Okay.
Because tomorrow morning matters.
A lot.
It's a big morning. We have data, we have earnings, and we have market positioning. It's a trifecta.
We have 3 major catalysts on the watch list. Catalyst number 1, the consumer pulse. Retail sales data drops tomorrow morning.
This is the big one. The whole soft landing narrative, the idea that we can bring inflation down without crashing the economy, it depends entirely on the American consumer continuing to spend money.
So if this number comes in hot, it means the economy is strong. If it comes in cold, the recession fears come right back. But there's a nuance here. We need to look at how they're spending. Is it all on credit card debt? Or is it from real income? If sales are up but savings are down, that's a ticking time bomb. But for tomorrow, the market just wants to see a Goldilocks number.
Not too hot, not too cold.
Exactly. Not too hot, inflationary. Not too cold, recessionary.
Okay. Catalyst number 2. Earnings before the bell. We've got the beverage giant Coca-Cola, KO.
I'll be watching this very closely, not because I care about soda sales specifically, but because Coke is a proxy for the global consumer.
What are we looking for in the report?
Volume versus price. For the last 2 years, companies like Coke have been raising prices to beat inflation, price taking. But recently, consumers have started to push back. They're switching to generic brands.
The Save-A-Lot Cola.
Exactly. So tomorrow, if Coke says, we raised prices and our volume dropped, that tells you the consumer is tapped out. It tells you pricing power is gone. And that would be very bad for broader market margins. We want to see if the consumer is still willing to pay that premium for the brand name.
Got it. Okay, catalyst number 3, the inflation lead-up. Now, this is your expert note. CPI is until Friday. Why does tomorrow matter for inflation?
Because the market is forward-looking. Tuesday is when the positioning starts. The whisper numbers are circulating around Wall Street. The market is nervous. We saw bond yields creeping up. The 10-year Treasury is at 4.20%.
4.20%.
It sounds like a meme number, I know, but it's a critical technical level. If that number starts creeping up tomorrow, say, to 4.25% or 4.30%, that is going to put serious pressure on the tech rally.
Okay, explain that math for the listeners. Why does the 10-year yield hurt tech stocks?
It's all about the discount rate. Tech stocks are valued based on profits they are expected to make, like 10 years from now. When interest rates go up, those future dollars are worth less today. It's like gravity. Higher yields pull down the valuation of high-growth stocks. So, watch the bonds tomorrow morning. If yields spike, the Nasdaq might stumble.
Okay, so that's the setup. Now, let's give the people what they want, the game plan. How do we actually trade this open?
We need to be flexible. We need scenarios.
Scenario A, the melt-up continues. The Dow 50K height carries over.
If the S&P 500 ticker, SPY, holds above today's close and we don't see a big pre-market dump, you look for continuation in the semiconductors, but not just any semi.
You're watching Intel, aren't you?
I am. If Intel holds that 10% gain from today, it tells me the rotation into lagging tech is real. It means money is looking for value in the tech wreckage. So if INTC is green at the open, that's a bullish signal for the broader market breadth. It means the rally is widening out.
Now, scenario B, the rug pull, the defensive pivot. What if retail sales are a disaster or those yields spike?
If the 10-year yield spikes, tech will get hit hard. In that case, you pivot. You look at energy, XLE, or gold. Remember, with the Transocean news, energy has a catalyst. And with gold bouncing, there's a safety bid there.
So if the screens turn red, don't try to catch the falling knife in tech. Go to where the safety is. Energy and gold.
Exactly. Don't fight the flow. If the money is leaving the casino, you go to the bank.
And here is the trade trigger for tomorrow. I want to make this super simple for everyone listening. Watch NVIDIA.
It's the bellwether, the canary in the coal mine for tech.
If NVIDIA goes red tomorrow morning, if it drops below today's close sit on your hands, cash is a position. Do not force it. But if NVIDIA stays green, we chase the momentum in broader tech.
Let's explain sector rotation really quickly, just so everyone gets the concept, because we've mentioned it a few times.
Yeah, plain English. Go for it.
Think of the market like a giant spotlight. It can't light up everything at once. Sometimes the spotlight is on tech, right? Momentum. When that gets too expensive, the spotlight moves over to energy or value. That movement is rotation.
So right now we are seeing the spotlight flicker.
Exactly. It's trying to decide if it wants to stay on the AI party or move to the real assets party with the drillers and the gold bugs. Our job is just to follow the light. You don't want to be standing in the dark.
I love that. Don't stand in the dark. Okay, before we wrap up, I want to talk to the community. We call you the Theta Fuse family for a reason. Being part of this community isn't just about listening to us ramble. It's about interacting.
We learn as much from you guys as you learn from us. I mean, the questions we get in the Discord are sharper than half the analyst notes I read.
Seriously. Join the channel. Drop your ticker symbols in the comments. If you're looking at a stock and you're not sure about the chart or you want to know the fundamental story, drop it in the chat. The expert and I look at these specifically for our Q&A deep dive sessions. We want to know what you are trading.
Absolutely. The collective intelligence of the group is always smarter than one person.
And finally, for my night owls.
Yeah.
The people who are going to be up late, staring at the ceiling, wondering if the market is going to crash while they sleep.
Guilty.
Here is your night owl tip.
Don't obsess.
Easier said than done.
I know. But here's the actionable advice. Check the futures, the ES for the S&P and NQ for the Nasdaq before you sleep. Just a quick glance. Right now, on Monday evening, they are muted and steady. The That means nothing crazy is happening yet.
So set your alerts. Is that the play?
Exactly. Set a price alert on Bitcoin. Bitcoin trades 204.7. It is the canary in the coal mine for liquidity. If Bitcoin breaks $70 pie to the downside, that's your wake-up call. That means volatility is kicking in.
If your phone doesn't buzz, stay in bed. Get some rest.
Yeah.
You're going to need the energy for the open.
Exactly. Sleep is an edge. If you are tired, you make emotional mistakes.
Sleep is an edge. I'm putting that on a t-shirt. All right, we are at Dow 50K. This is history, people.
Yeah.
But remember what Larry Fink said. Don't just watch it happen.
Own it.
Own it. Be an owner of the growth.
Understand the infrastructure, understand where the value is flowing, and don't be a spectator.
That's the mission. Stay disciplined, watch the theta, and I'll see you at the opening bell. Peace.
Good night, everyone.